Welcome to Michigan Historic Preservation Network's August webinar, the Historic Tax Credits. My name is Xiaohan Smith. I will be your moderator today. And before I turn it over to our speaker, I would like to go over some Zoom items. If you have any questions, please type them into the Q&A box as you think of them. All the questions will be answered at the end of the presentation. And if you have any technical difficulties, please also type them into the Q&A box. The chat box will be used to share links or resources discussed during the webinar. Both the chat box and Q&A box are located at the bottom of your Zoom screen. If you don't see them, please wiggle your mouse and they should pop up. If this is your first time attending our webinar, we are the Michigan Historic Preservation Network. We support the sustainability and economic viability of Michigan's historic places through advocacy, education, and direct action. We could not do the work we do without our members and volunteers. So if you're not a member yet, please consider joining us at www.mhpn.org. And we would like to invite you to our 32nd annual MHPN Fall Benefit, which is scheduled on Saturday, October 3rd at the Rochester Hills Museum at Van Hoosen Farm. The information and link to the event details is in the chat box. Please check it out. And if you're seeking AICP continuing education credits for this webinar, you will need to log in your credits online using this link, and this information has been sent to the chat box. And if you're seeking AIA credits, please email me your name and AIA number after this event. And my email address is also in the chat box. Our webinars are supported in part by an award from the Michigan Arts and Culture Council and the National Endowments for the Arts. And we want to say a big thank you to our sponsors. It is my great pleasure today to introduce you our speaker, Emily Godzillo. Emily is a first vice president and director of Mercantile Community Partners of the Mercantile Bank. And Emily is also our board treasurer. So with that, I am going to turn it over to our speaker.
Awesome. Thank you, Xiaohan. All right. Are you seeing my screen?
Yes.
Okay, cool. Welcome everybody. Excited to present today about historic tax credits. As Xiaohan mentioned, I get the privilege of serving as MHPN's board treasurer. And during the daytime, I am the director of Mercantile Community Partners, which is a subsidiary of the bank that was formed about 3 years ago, specifically to provide tax credit investment in projects that are utilizing primarily low-income housing tax credits or historic tax credits. I've been in commercial banking about 15 years, of which 10 of those I've spent in the tax credit space, working on projects primarily in the state of Michigan, ranging from sizes of 2 to 3 million in total development costs, all the way up to 150 million development costs. So I've seen a wide array of projects utilizing these incentives. So happy to share a little bit about how those work with you all. A quick snapshot of what we've been working on here at Mercantile. The projects listed here in blue are historic tax credit projects. Interesting fact, 5 of them are old schools that are being revitalized primarily into housing. Old schools tend to be a common asset class that we see in this space. So excited to see that keep working in communities across the state. So digging right in, what is a tax credit? So a tax credit is a dollar for reduction in your tax liability, meaning if you owed the IRS $1 million and you had $500,000 in tax credits, now you only owe them $500,000. So it reduces the amount that you owe to the IRS or at the state level. Um, Tax credits are generally part of policy and they are used to encourage certain type of investment and economic growth. So over time, you will see that these programs do change when there's specific socio-economical priorities that we are working on. Tax credits can be at both the federal level and the state level. There are some similarities to those, but also differences, which, excuse me, we'll get into later in the slide. Generally speaking, the tax credits are often monetized or syndicated to create cash for the project's development. Again, we'll kind of dig into the differences of what it would mean if the developer were to keep the tax credits themselves, or if they were to monetize or syndicate those credits to a third party. Again, depending on the tax credit program, the incentive program that you're using, eligibility, the application process, the compliance, the reporting, all of that fun paperwork and timelines may differ depending on the program. I'd also note that the programs do change fairly frequently, and so always good to make sure you have the most recent information, which is often found on the State Historic Preservation Office's website here, SHPO, or the National Park Service's website. To give the audience here a kind of a idea of who's using tax credits, how much of these tax credits are actually out there. Here's a snapshot from the National Park Service, who administers this program on a federal level, of some stats of last year, 2025. There was just under $9 billion worth of private investment made utilizing historic tax credits. Because we know many communities, if not all, are struggling with providing affordable housing to their community members. They've also tracked, the impact that these tax credits have on housing. Below, I've included some data on Michigan facts and what we're doing here in the state. We have lots of projects that have been approved in the process and are working on being rehabbed utilizing these programs. Right now, we don't have reporting on the current state credit and how many projects that have actually utilized that to date. So hopefully we'll get some more of that data here in the future as that program continues to ramp up. Often I like to also include some information on, when you think of a tax credit, often it may be misunderstood that the government is losing money by providing these types of programs, when in fact, the benefit that is produced from these incentives is greater than the cost it is for the government to run the programs. The numbers here on this slide are through 2023. More recent information is not available yet, but still wanted to provide this snapshot to give folks an idea of how many jobs are created, the impact to the GDP. Again, it's not just on a project by project basis, but also in a macroeconomic view. So when we are talking about historic tax credits, it is a federal program that was created in 1976. It's administered by the National Park Service and the State Historic Preservation Office. I'll reference to that as probably SHPO throughout the presentation here. In Michigan, our state tax credit was reinstated about 6 years ago now. 38 states across the country also offer state credits in varying capacity. I will say our state credit is capped at $5 million a year, which is on the lower end of our neighboring Great Lakes states. So you may or may not be aware, MHPN works closely with legislation trying to improve our program to be able to make a larger impact. More to come on that. I think that there's probably other webinars as we get closer to timelines that make sense for additional lobbying. But um, so today I'm going to assume that your building has already gone through step 1 and 2 here of eligibility requirements. Meaning your building is either already on the National Register or you've gotten approval to add it to the register, and that you are either partially through or have received Part 2 approval, meaning that you have provided SHPO with your plans of what you are expecting to do when you're rehabbing the building. This Part 2 approval is what really drives making sure that the tax credits will be in fact eligible. And so we want to make sure that the work that will be done on the building will be done so in accordance with the Secretary of Interior standards. I am not an expert on what those standards are. That is something you would need expertise from a historic consultant and SHPO themselves. So we're just again going to assume that all that heavy lifting has been done, and now we know our project is on the register and the rehab construction plans that we have are done in accordance with the standards. And so now we're going to move on to the next 2 eligibility requirements to test that they can actually generate the tax credits themselves. So the next eligibility requirement is that your rehab has to be substantial. So you're not able to generate a tax credit if you are replacing 3 windows in a building. It has to be a substantial rehab. What does that mean? Your cost that you're putting into it is greater than what you paid for the building in the most basic of terms. In the technical terms, in which the ones that accountants and investors will be looking for, is that your qualified costs or your construction costs to rehab the building exceeds the building's basis, which means if you've owned the building for a long time and you've been able to depreciate it, you might have done improvements, that all needs to be taken into consideration of the beginning basis of the building before you rehab it. I would say oftentimes, if it's a newer or a building that you have purchased, many years ago, or you've been able to acquire at a low acquisition price. Typically, I don't see too many projects have trouble meeting this third eligibility requirement, particularly as construction costs continue to increase. The next eligibility requirement is that post rehab, your building must be income producing for at least 5 years, which is the historic tax credit compliance period. Income producing does not mean that nonprofits cannot work in this space. What it means is that the building needs to have some sort of either operating business in it that is generating income or generating sales and costs, or it needs to be a use that someone's paying rent for it, the space. So again, it could be occupied partially by nonprofits. So again, that income producing piece sometimes tricks people up, but there's ways to also structure around that if you need. But so the federal credit is not applicable to residential owner occupied rehabs. And just to distinguish, that's on the federal side only, not the state side. So what are qualified costs? So QREs, or qualified rehabilitation expenditures, which is a mouthful, are the costs that qualify to generate the credit. Those costs are mainly anything that you do to the building as far as rehabbing it, that when you shake the building, it doesn't fall out. So all of your major building envelope, the utilities, um, all of the construction that you are doing on the historic portion of the building would count. You also get credit for construction costs, carrying costs, such as bank interest, taxes, other costs, your architectural, engineering, your historic consultant costs. All of those will qualify generally for tax credits. What doesn't count in that calculation is the land, what you've paid for the building, if you are doing any types of site works, a playground, building, more sidewalks, anything that is exterior to the building. In addition, if you are expanding the building with SHPO's approval, um, anything deemed new construction, even if it's attached to the building, would not qualify. And then additionally, what we would consider personal property or furnitures, fixtures, and equipment, those do not count as QREs. You might see in this list of very specific tacked carpeting versus glued carpeting. Some of the QRE definitions can get really nitty gritty. This is not an exclusive list. These are just examples of what may qualify. The which is coming directly from the IRS website. If you have a project that is unique and has, a whole slew of different components where you are trying to figure out what may or may not be QRE eligible, um, I would recommend getting connected with an accounting firm that will help with that and will help also certify that those costs are QRE eligible. Um, One of the firms that come to mind here in Michigan is Plant Moran. They have a whole group that is specializes in this space. So now that we know our building qualifies, we know how much it's going to cost for us to rehab it. We have an estimate of how many of the costs will qualify. This is how we generate what the tax credit is actually going to be. So in this example, we have a $4.4 million project, of which just under 90% of it qualifies for credits. So of the 3.8 million in qualified costs, if you're looking at a federal tax credit, that's 20% of those costs. So it would generate a $765,000 credit. On the state side, Michigan's QRE are multiplied by 25%. You'll note the differences again here between federal and state. State is capped, so at a maximum of $2 million per project. It's first come, first serve. And so once you are awarded a certain dollar amount of credits on the state side, that is your award. Whereas on the federal, there's not a cap. It is a true calculation based off of your qualified costs. However, you must be sure that any related party costs are deemed reasonable. So you can't artificially inflate your costs to just generate more QREs. There was a large Supreme Court case about this back in, I think, 2012, maybe 2014, called the Boardwalk case, in which a lot of the guidelines around the federal credit were established and how to structure these transactions. Another difference between these is how you get to claim the credit. So on the federal side, that $765,000 credit is going to deliver over a 5-year period. Whereas on the state side, your $950,000 credit is going to deliver in 1 year. Um, Both credits are not available until construction is completed. So even though you now know you qualify, you have your dollar amounts, the actual tax credit itself isn't legitimized until the project has been completed and has received its Part 3 approval from the National Park Service. Um, that means that in the Part 3 approval is basically the stamp of approval that says, hey, everything you said you were going to do in Part 2, which is in accordance with the Secretary of Standards, we're stamping off that, yep, you did it. And it's still in compliance with the standards and agree that this would qualify and generate a tax credit. So in terms of timing, again, that is when those credits would be available for the taxpayer to start claiming once the building is completed with construction. So, how are the tax credits claimed? So now you have the tax credit and you are trying to decide who can use it. Again, there's differences between the federal and state. That's an ongoing theme. On the federal side, the tax credit, so that $765,000 tax credit, would be allocated to anybody that has ownership in the property. And it's allocated based on their ownership percentages. So those credits can flow through to individuals, corporations, any of the entities that you would typically see in an ownership structure of the building. There are additional requirements if an individual is hoping to claim the credit on their personal tax return. That you must be deemed a real estate professional or have substantial amount of passive income that you can use to offset the credits. So for transparency's sake, generally it's pretty challenging for individuals to use the credits themselves. Depending on the size too of the credits, but more often than not, we see business entities using the federal credit. On the state credit, you have an option. You can either have the property owners absorb that benefit, and you can slice and dice it and split it up however you want. It doesn't need to follow the ownership structure like the federal credit does. Or if you were looking to turn the credit into cash, you can sell it. And one of the big distinctions I want to make here is on the federal side, if you're not selling the credit, you're having somebody make an investment because they're being an owner. Whereas on the state side, you're truly selling it because it's a complete third party and they're not an owner. And that is an important distinction to make sure you're aware of when you're structuring these. Again, kind of noting when the credits themselves are available, the 5 and the 1 year difference. There are different carry back and carry forward rules. So in the event as a taxpayer, you don't end up having enough tax liability to soak up the benefit of the credit, you may carry it backwards or forwards into subsequent years. However, the credits are non-refundable, meaning if you have credits in excess of what you owe, you don't get cash back from the IRS. So it only reduces what you owe them. You won't get a refund like you may see on a personal return. So once the tax credits start flowing, the building has been constructed in accord or rehabbed in accordance with the standards, and the tax credits start flowing, they are subject to recapture by the IRS for a 5-year period. That period starts the day the building's placed into service, meaning it's received its certificate of occupancy, and that starts the compliance clock. Remaining in compliance means that you need to keep the building's historic character unchanged. You cannot sell or transfer interest in the building during the 5 years. And if there's a casualty loss, which may be insured over in some cases, that may cause recapture where the IRS comes back and says, we want our tax credit back. That on the federal side, that recapture risk remains with the taxpayer that's claiming the credit. Where on the state side, if you were to sell your credit, the compliance period burden remains on the property owner, because remember, your state credit can be sold to a complete third party. So they're not in their purchase, they're not purchasing the risk. The risk remains with the building owner. I would say in my experience over the last decade, I have not experienced a tax credit recapture from the IRS. There are cure periods for all of these triggers. I'm sure it has happened in the life of the tax credit program itself. But I have not luckily experienced that in the last 10 years or so. So now we're getting into, okay, I know my credit amount. I think I know when I can get it because, my construction period is going to be 12 months. So hopefully it will be ready next year. Do I want to keep that tax credit for myself? Or do I want to syndicate it, monetize it, sell it? Again, because they're different, the way it works on the federal side is you would need to create a ownership entity with an investor, such as myself at the bank, and the investor is going to take a 99% limited partner interest in the building. The reason why the investor is going to look for a 99% interest is so that they can get 99% of the tax credits. This often brings a building owner or business owner kind of a pause. Wait a minute, why am I going to give up 90% of my building? The investor is not in a position to operate the building, and so will rely solely on developer building owner to construct it, operate it, ensure it remains in compliance. And in exchange, typically the developer and owners will get fee sharing out of that to ensure that they also are getting an economic return on their own investment. The investment rate in which a federal tax credit investor is willing to pay depends on a whole lot of things. But most often, the most immediate question is, how large of a credit is it? Outside of the normal underwriting real estate risk and construction risk, the size of the tax credit also determines the investment rate. In this example, you'll see 70 cents on the dollar. So our $765,000 tax credit, if we were looking to have a corporate investor use that, they may give you $530,000 in cash in exchange for those credits. That being said, they're not going to give you the cash all at once. It's going to be paid in over time. Whereas on the state side, that, again, the calculation is a larger amount of credits because the credit delivers to the taxpayer in 1 year instead of 5. It's a quicker return of their investment. And so they may be willing to pay a higher investment rate. And that's why you'll see the 85 cents on the dollar here on the state side. Something specific to note, if you are selling a state historic tax credit, the proceeds you receive are considered taxable income. So in the event that you don't have enough building or enough depreciation being kicked off from your building, there may be a negative tax impact to the building owner when selling the credit versus using it themselves. On the federal side, because the investor is an actual member, has owner in the building, it's not a sale, so it doesn't create income. It's a true capital contribution from the investor into the building. So this is a slide that shows the example of the federal investment and the state in the timing of when those proceeds come in. So as I mentioned before, the federal investor may say, great, I'm going to give you $530,000 towards your project. Thank you for the credits, but I'm going to pay them in over time. And primarily to mitigate their risk, because remember, the tax credit themselves, even though we've gotten eligibility and we know the building qualifies and all of that other stuff, the credit itself is not flowing until construction's complete. So typically an investor is going to hold back quite a bit of their capital until those milestones are reached. Typically, the largest dollar amount contributed is when you get that Part 3 approval, that final stamp from the National Park Service that everything's been done in accordance with the standards. And so because of that, because of this staged pay-in, and also because the state proceeds are not going to come in until the end, often what's needed is a bridge loan in addition to your normal construction loan. And what that's doing is providing the capital you need now to get the rehab and construction completed. And that loan would be fully repaid when the federal investor and the state buyer provide capital. So if you're looking at your project and trying to size out what size of a construction loan do I need, if you're planning on monetizing, selling, syndicating your credits to a third party, you're likely going to need a bridge loan. The bridge loan would operate just like a construction loan. Often it's best if your construction loan lender and your bridge lender can be the same, come from the same place to help not only minimize transaction costs, attorney costs, but to help with underwriting risks as well. So again, on the federal side, this is a kind of a quick org chart of what that looks like. Where the investor member in the top right corner, gray box there, they're going to take 99% of the credits. You'll also note it says cash flow. There are ways that we can structure certain fees such that the developer and owner can effectively grab as much of that cash before it gets distributed to the partners. So to lessen some of that shock value of, wait, why would I bring in an investor? They're taking all of my benefit. Again, there's ways to structure around that to ensure the operational cash flow remains as much as possible with developer. When you're looking to syndicate your federal credits, there's two different structures. What you see here is considered a single entity structure. We're not going to get into the master tenant structure. It's a more convoluted. But one of the things to note here is outside of what the investor's willing to pay for the tax credits themselves, they're going to have a whole other slew of structuring components, like their pay-in schedule. What percentage are they going to give at closing? What are they going to give at completion? Those percentages I showed earlier could be considered, excuse me, standard, but they can change depending on your investors' risk appetite and investment motivations. Typically, investors may also charge some sort of priority return on their capital or an asset management fee. Um, Again, that might be if they are going to pay 80 cents on the dollar for a credit, they might then charge higher fees throughout the 5-year period. Or they may say, I'll only give you 70 cents on the dollar, but I won't charge you any fees. So there's room there when you're looking at negotiating with an investor. What is it they're looking for? Is it the spread on the tax credit that they're paying, that investment rate, the 70 versus the 80 cents on the dollar? What are their other fee expectations? Um, what other reserves or contingencies are they going to require? So they may require that you have an operating reserve. They may require that you carry a 10 to a 15% hard cost contingency in your budget. And again, a lot of those are to minimize construction risk and operational risk during that 5-year period in which they serve as an investment partner. Typically, part of a federal syndication is, it's not on this list, I completely missed it, is a put option, which is a pre-negotiated price that the investor is willing to be paid to leave the partnership. So at the end of the 5-year compliance period, the investor has the right to put its interest back to the developer for a pre-negotiated price. And again, what that price is all depends on what's going into the bucket of the investment rate and other fees. Um, there are different types of investors out there. Some investors do want to stay in the property and have a longer term interest in the property. Other investors look at it as, hey, I got 5 years of my tax benefit, I'm out. And so that's something to keep in mind as you may be looking for a potential investor partner. One of the other uniqueness or yeah, that was a weird word, but one of the other pieces to keep in mind is a federal investor is also going to require that any party with a mortgage on the property signs a forbearance agreement, meaning they can't foreclose on the building because that causes tax credit recapture. Traditional banks don't always love that. However, the banks would be able to exercise all of their other rights, such as accelerating payments, calling on their guarantees. They would have all of those rights under their loan documents, except for actually foreclosing and taking back the building, which would cause a large recapture event for the investor, who would then turn back to the developer and say, my tax credits were recaptured and I would like you to repay me for that. So risks for all folks around. The other thing to keep in mind that I have on this list is tax credit adjusters. So if you are looking for an investor and you say, hey, I've got $765,000 of credits and they're going to start flowing in 2028. Well, if they don't start flowing in 2028, like you told them, they might say, well, now I'm going to pay you 4 cents less because their time value of money has now changed. So keeping that in mind again with what is the investor's expectations in terms of when the tax credit's available and their fee structures. So a little while back, I had mentioned that the federal credit often is priced, or the investment rate, if you will, is dependent on the size of the project. A lot of that is driven by the tax credit being delivered over 5 years. In this chart, I wanted to kind of highlight that difference because sometimes it just doesn't make sense to syndicate or sell your credits. Um, Often that is the smaller end of the projects. As you can see, not only did we include an investment amount, but along with that comes a bunch of legal, accounting, those fees that I talked about earlier that they may want during the 5 year period, plus the price they want to get out of it, brings your investment rate down somewhat substantially. And so based on the size of your project, that may not there may not be enough juice worth the squeeze on that. Unfortunately, it takes the same amount of effort and work to close a $1 million deal than it does a $15 million. And so that's why you'll see the legal and accounting are just kind of fixed. That's one of the pieces that is most challenging in smaller deals, is how to offset some of these additional costs that come with a tax credit investment. This changed around 2017 when tax reform first came about. Not only did it lower the corporate tax rate from 35% to 21%, completely changing investors' appetite, right? They no longer owe the government more money. There's no longer incentive to get more tax credits. And also tax reform changed the federal credit to deliver over 5 years, where previously it would deliver in one, like the state credit. But right now we're working with a 5 year credit, and that time value of money has now been reflected in the investment rate that syndicators are willing to pay. So when should you talk to somebody about syndicating your credits or monetizing them or buying them? It's never too early, and in fact, the earlier you do it, the better. Because your investor can help have conversations with the other parties, your banker. They can help provide guidance in not only what they're looking for out of the investment, but what hurdles they may see from their experience. It can be too late. So on the federal side, if you have completed your rehab and you've placed the building into service, meaning you've received a certificate of occupancy, whoever was the owners of the building at that date are the only ones able to use the credits. On a federal tax credit, you cannot admit a member after the fact and have them use the credits. So again, making sure, understanding the timing of when you need the cash from that investment versus when you're going to complete the building and the credits are flowing is important. Closing times on these projects typically take longer than your traditional real estate. I have 90 to 120 plus days listed here. I would say 90 is typical. Sometimes we've been able to do it in 60 days, but all of that really is driven by the team that you're going to pull together as you work through these processes. So, obviously investors are looking for folks that have some sort of development experience, and if not, that they've brought along a general contractor that has, and a historic consultant that is helping guide the plans and ensuring they're in accordance with the standards. And an attorney that can help negotiate the partnership agreement that developer and investor are going to be negotiating. The accountant, if your accounting firm needs to be familiar with what is a QRE and how are these going to flow onto the tax return ultimately. If your investor and your lender are coming from different shops, make sure that they chat sooner than later, specifically about that forbearance agreement that we talked about earlier. And also title companies and insurance companies, just there's not everybody is familiar with tax credits and their specific requirements from a title company and insurance policies that your investor is going to look for. So making sure you understand what those requirements are and that you have an insurance company that also is understand and able to underwrite that into your policy is also important. This is a quick snapshot of underwriting information that a tax credit investor is often going to look for. They may not look for all of this. You know, you don't have to have this list completed and hand a full package, but at some point during your conversations with investors, they're going to be asking for these items. Um, Particularly a construction budget, we're going to want to see it detailed, going to want to make sure that you have those appropriate contingencies in case, you know, there's always in a historic building a surprise. There's always an unforeseen condition, and have we planned for those? Um, in addition to that, we do like to see your part one and part two approvals from SHPO and NPS, along with any other sort of term sheets or documentation and some of the other incentives that you may be using as part of your capital stack. Again, not an extensive list, but just to give you an idea of what financiers are going to ask of you. Some lessons that I've learned over the time is to set realistic and conservative timing expectations. It's always better to, you know, promise something might deliver later and deliver it earlier. Knowing that there's gonna be issues, I don't even know if that's the right word, but there's gonna be road bumps during the closing due diligence process when you bring an investor in and they start digging through everything. There's gonna be questions, there's gonna be more things that feel like a hurdle, but they always get worked through. I often say when you're using a tax credit as a part of your capital stack, it's not a matter of if the project will get done, it's just a matter of when. And again, setting those realistic timing expectations are really important. Um, Getting to know your tax credit investor is really important. Again, understanding their intentions, what their long-term plan is, because they are a partner for 5 years and most likely 7, because it takes, you know, a year to get stuff together, a year to construct, and then a 5-year compliance period. So they're in it for the long run. Again, while they don't operate the day to day and they rely on developer to do that, they do have the right to remove said developer for bad acts or if they haven't delivered what was expected within the partnership agreement. I just wanted to also add a quick slide here on other types of financing incentives that I often see with tax credits. Often you may see that there's grants out there, long-term or forgivable loans, TIF, tax increment financing, whether that's coming through the municipality, property tax abatement. All of these tools are going to help finance your capital stack to make the rehab possible. Most of these tools can be found with the Michigan Economic Development Corporation, MEDC, or the Michigan State Housing Development Authority, MISTA. We could probably do a whole webinar on every single programs that they've got offered too. But just wanted to make sure you folks are aware that almost every project I see has more than one incentive in addition to the tax credits. And just quickly to give you guys a sense of projects that have gotten done recently where I've served as the tax credit investor. The first one is the annex building up in Sault Ste. Marie. This was about a $4 million project, which generated $686,000 in total tax credits. You'll see here the capital stack also had at MISTA and MEDC funding. If you are working with MISTA and MEDC on a project and you know, they know that you've also brought in a tax credit investor, that also shows you have exhausted every incentive out there. And so if there's still a gap showing in your capital stack, there may be more incentive for those parties to provide more funding. and from my experience. The next one, a fun one, the Bonsall Theater in Detroit. This was just under a $10 million project. This had a grant straight from the state budget. So they got an appropriation from the state budget along with tax credit equity. This one was on the larger, quote unquote, larger size. So the total credit is $1.5 million. So you'll note from the previous slide, this investment rate is higher than the quote unquote smaller project. Favorite one of many. This is the building you saw on the intro of the webinar. This is Walter French in Lansing. This project is actually done in two phases. It uses LIHTC and historic. The capital stack you're seeing here of 10 million is just the commercial condo space of the building. So it didn't include the residential spaces, but it included on-site daycare and office space for the nonprofit development team. Again, a little bit on the larger side, over $1.5 million in credits. And then last one, just as an example, is the Oddfellows building in Midland. This is again about a $4 million project. Again, you'll see the MEDC's got some funds in there. This project is under construction now and should be done by the end of this year, hopefully, because I'm expecting 2026 credits. So fun projects. Again, you kind of see the range of the sizes. The structures might be slightly different, but they're being used across the state. So that is very exciting. And I think that's the end of my slideshow. Shohan, do we want to do questions?
Yes, thank you, Emily, for your
Yeah.
presentation. That's a lot of information there.
It's a lot of information. It's a lot of information. So, yes, happy to answer questions. If we run out of time now, happy to find time to connect with folks too to answer questions.
Yes, I see somebody raise their hand, but if you have any question, could you please type them into the Q&A box so we make sure we can address it? So I'm going to do our first question. So what determines the beginning and end date of the recapture period? Is it when the building receives a certificate of occupancy, or establish the place in service date, or is it when the project receives its Part 3 approval, or like what is a date?
Yeah. So the compliance period starts when the building receives its certificate of occupancy, which typically establishes that placed in service date. So you can have a placed in service date before you receive Part 3 approval. And so again, yeah, that compliance period starts with, I'm done with construction, the building has been placed into service, we've got a certificate of occupancy.
Okay, thank you. And I think there was another question about, let me go to that quick. Is there a substantial rehab cost for residential state credits?
That's a good question. To be honest, I don't know off the top of my head. Most of my work is on the commercial side. Oh, Brian Lujeski says yes from SHPO, that yes, there is also that substantial rehab test.
Okay, I guess if you have further questions, please reach out to SHPO regarding this. Okay, let's go to next question. Is a phase 3 final inspection typically done in person by a rep from the NPS or SHPO, or is it more a picture review of the completed work?
In my experience, I believe at least somebody from SHPO typically is on site for that phase, the Part 3 approval and final inspection. I know they often are on site, during the Part 2 process, if it's at the beginning or towards the end of getting that approved. I'm unsure if NPS travels. I do know photos are a requirement of submitting those approvals. But I guess if SHPO has any comments on that of what's required of in-person versus photos, that would be great.
Great. Okay, another question. Oh, is a slideshow available after the webinar? Yeah.
Yes, yep, happy to send that out to folks and again, as more questions pop up, happy to chat through that.
Mm, yes. And if you have any questions regarding a specific project, I think you would like to reach out to Emily afterwards. Yeah, we can connect you. And I think there was just one more question. Could you talk a little bit more about the costs associated with the tax credit syndication?
Sure. So on the, well, I'll start with the state side. Since the state is if you are monetizing that, remember that's a sale. That can be done with a purchase agreement. So typically a 1, 2 page document to document the sale and that to effectuate that. Whereas on, so there's minimal attorney costs on the state side. On the federal side, because the investor is going to become a 99% member of the building, there's more extensive legal costs in preparing an operating agreement. That's not just your, I guess, standard boilerplate operating agreement. It is got a lot of tax credit specific items that are built into that. So that creates more of a heavy lift from an attorney standpoint. And also on the accounting side, investors are going to want to make sure that we have a really good estimate of what costs qualify, and ultimately a certification from an accounting firm that those are in fact qualified costs. And so, those two, I think legal and accounting costs are hard to avoid on the federal side. But they do count as QREs. So even though it's not a dollar for dollar benefit, you're not getting, a full tax credit off your costs. It still, it still qualifies, so helps from that space.
Thank you. Is
Yeah.
there like a point that you should consider syndicating your tax credits to make those costs worth?
I would say in my experience, typically if your project is under 3 million in total development costs, it generally doesn't make sense on the federal side. Um, it's a lot harder to find investors that will be interested in that size of a project. It's not impossible. But again, that's where the state program can help fill that gap. Um, but yeah, I would say it generally, if it any smaller than about 3 million in total development costs, it gets really challenging on the federal side to syndicate.
Okay. Thank you. I think that's all our questions, and we're about time to close. So thank you, Emily, again
Yeah.
for your time and giving us this presentation. And this webinar is being recorded, and the recording will be available in the next couple of days. So you will receive an email when it is available, and feel free to share it. And I just want to quickly announce our next webinar, which is scheduled for September 24th at 1 p.m. and the title is Tried by Fire. And if you are interested, please click that link in the chat to learn more and register. And I hope to see you all next time. Thank you. Thank you, Emily.
Yeah, thank you.